Federal taxes. In Australia, personal income tax is levied on all wages and/or salaries. Note here that there is a very slight difference between salaries and wages. A salary is a fixed payment spoken in terms of dollars per month or dollars per year. A wage is an hourly payment rate. How much you earn is determined by the hours that you work. Personal income tax is a direct tax as the impact and incidence both fall on the taxpayer. It is also a progressive tax, meaning that the higher income earners share more of the burden than the low income earners. Personal income tax is levied at marginal rates. In other words, this means it specifies how much of the last dollar earned will be paid in tax. In Australia, tax brackets specify at what income levels the tax rates change. As of July the 1st, individual income tax rates are as follows. For the first $18,200 you earn, you pay $0 tax. From that mark up until $37,000 tax, you pay 19 cents on each dollar. From $37,000 to $80,000, you pay 32.5 cents tax for each dollar, plus $3,572. From 80,000 to 180,000, you pay 37 cents for each dollar, plus $17,547. And for every dollar you earn above $180,000, you pay 45 cents tax, plus $54.547. Unlike personal income tax, company tax is levied in a proportional manner, meaning that businesses at every level of the profit share an equal burden. It is generally considered to be an indirect tax, whilst the impact falls on the company. Generally, the incidence falls on the consumers as price rises in response to the tax. The company tax in Australia is currently 30%. This rate applies to almost every business in Australia, with a few exceptions such as various forms of financial institutes. Goods and Services Tax, or GST, is levied on most goods and services supplied in Australia. The impact of the tax falls on the consumer, however the incidence falls entirely on the consumer because the added production costs are passed directly on to buyers through the form of higher prices. It comes in a flat rate of 10%, meaning that for low income earners the tax will represent a higher proportion of their income compared to high income earners. Therefore, the tax can be said to be a regressive tax. The revenue raised from the tax is passed straight on to state governments. Excise tax are imposed by the federal government in an attempt to address negative externalities in our economy. Excise tax is imposed on goods in Australia such as alcohol, tobacco, oil and gas, amenities that have negative externalities. The tax, which is a key source for revenue and the government, is generally imposed on price inelastic goods as to ensure that the consumption patterns are not majorly affected. Like GST, excise tax is levied in a regressive manner as the flat tax rate. Fringe benefits tax. Employees who receive non-cash benefits on top of their salary or wage may be subject to paying the fringe benefits tax, or FBT. These non-cash benefits can include company cars, school fees and low-interest loans. Capital gains tax, or CGT, is levied on profits made from the sale of capital assets held longer than 1 year. Assets sold that have been held for under 1 year are taxed as normal income rates. This tax is levied on assets such as shares, investment properties, and personal items such as jewellery that were purchased with the intention of reselling as profit.